Hey guys, it's Jordan with Cashflow AI, and in this video, we're going to talk about understanding uncorrelated strategies, which is one of the keys to portfolio stability. And so, what is correlation? Well, it's basically how closely two strategies or two bots move together. And so, there's something called a correlation coefficient, which is a number between -1 and 1 that measures how strategies move in relation to each other. So if you have something which is perfect correlation, that's going to be a 1, which means there's no diversification. They basically move exactly the same. When one wins, the other one wins as well. Zero correlation would be at 0, which means they move independently, which is really good for diversity. And then the last one is -1, which is negative correlation, which means they basically move in the opposite, which is also known as a really good hedge. And so why correlation matters so much is because if you have all your bots that have extremely high correlation, well, when one crashes, they all crash. You can see if this red line is one bot and this dotted line is another bot, well, they basically follow the same pattern versus one other one that has low correlation, right? So you have two strategies. One of them is this green dotted line. The other one is a solid line. You can see when one of them goes up, the other one goes down. And so this acts as a really good hedge at very low correlation. So when one struggles, the other ones stay very strong. Now, real examples, you can kind of look at this as two different bot strategies. So let's say, for example, we have an iron condor strategy. Well, iron condors make a lot of money in low volatility because they sell premium, and they profit when the market is relatively calm. Now, the other bot would be a long straddle. This one's the opposite, right? This one buys premium and high volatility. This one profits when the market makes a really big move. And so naturally, they're going to offset each other, right? When bot A does really good, bot B isn't going to do as good. And you can see how if you have diversified bots, usually you can end up with a very solid return overall when combined. And because these pretty much are exact hedges of each other, they have a very low correlation of -0.65, right? They offset each other. Now, so what do these numbers actually mean? Well, -3 to 0.3, kind of basically in the middle or around 0 is excellent because these are bots that are independent of each other. They're uncorrelated. That's essentially what you want. Now, if they get up to a 0.4 to 0.6, that's a moderate, some diversification. If it gets up to 0.7 to 1, that's extremely high. You typically don't want to use these together. And if they're down to -4 to -1, well, you're looking at something that's a perfect hedge, okay? When one does good, the other one does good as well. And they're pretty rare but powerful. Now, typically, what you want to look for, in my personal preference, is something that's closer to 0 or closer to -1. Because having all the same strategies that work exactly the same, well, it's basically the same as just having one bot. So it's not too diverse. But if you have ones that hedge against each other, and then you also have a few that are very independent of each other, that's going to be a very solid mix. Now, some common mistakes to avoid is that if you are running the same type of strategy, you're going to have the same correlation. So if you have 3 different bots and they're all iron condor bots, well, they're going to have the same correlation. Now, only checking correlation at the start is also really important because market conditions change, and so you really want to recheck all of this monthly or on a weekly basis. And the last is using less than 60 days of data. You really need a lot of trades for this to make sense. So you want to look longer than 60 days. 90 days is a good sweet spot to really understand what your correlation is and go from there. Now, strategy types that don't correlate, okay? These are ones that you want to mix together for really good diversification. So there are certain ones like volatility-based strategies, ones like iron condors, ones like credit spreads, or butterflies, right? These ones tend to work really well in low volatility or range-bound markets, right? Then trend following. These are more vertical spreads or debit spreads. These are more directional or simply basic calls and puts. These are directional that follow the trend. Now, you can also build credit spreads that work really well with trend following. You can build butterflies that work really well with trend following. But for the most part, these are the types of strategies that work well in trending or strong momentum markets. And then there's volatility expansions. These ones are really, really good hedges to the volatility-based markets, right? So long straddles, long strangles, calendar spreads. These ones work really well in high volatility and really big moves. And if you're able to combine it with volatility-based trades and trend-following strategies, well, you're going to have a very good, diverse portfolio. And so really, here's kind of like a recommended starting portfolio for a mix. This is not financial advice, but this is something that you could use as a portfolio. So if you want to put 50% into a volatility selling portfolio, 30% in trend following, 20% in volatility expansion, that's going to allow you to be very diverse, or even a simple 33% split on all of these would work as well. Now, how to actually calculate your correlation? Well, what you can do is export your daily returns from all your bots. And you can basically put it in Excel and just copy this formula. So if you just go in Excel and type in CORREL, and then you do the bot returns of A, the bot returns of B, you will get what your correlation coefficient actually is, just like that. There's a lot of other tools online you can simply look up for free that can do this for you as well. Now, the correlation matrix is something you want to build, and this is the most important part when it comes to building uncorrelated strategies. And so what you want to do is line up your bots on the left, your bots on the top. You can basically build a mix of how does each bot have its correlation coefficient compared to all the other bots, right? So if we look at bot C compared to bot B, well, that's a correlation coefficient of 0.31. Right? And so it's typically pretty low, which is pretty good. The blue ones are in the negatives. You can kind of get a sense of how your correlation matrix should look. And if you see a lot of strategies that are very high, closer to 1, above 0.5, that is some potential cause for concern, and you may want to look at changing some of your strategies in your portfolio. Now, last slide here, before going live, calculate your correlation between all bots, right? Make sure you have at least 90 days of data per bot. Ensure the average correlation as a recommendation is below 0.4. And you can build your matrix in Google Sheets or Excel, and really you want to recheck this every 30 to 60 days to make sure that none of this has changed and your bots stay uncorrelated or diverse, because that's going to allow you the best chance at having a bulletproof portfolio system. So I hope you guys did enjoy this video, and I'll see you all in the next one.